The U.S. China confrontation is entering a decisive phase, marked by a series of powerful economic countermeasures. What is driving vehicle prices to surge goods to become scarce, and loan interest rates to spike, all within this very summer. Beijing has instructed domestic airlines to suspend the receipt of Boeing aircraft and temporarily halt the purchase of American aerospace components. Within 48 hours of this directive, Boeing's stock dropped by 9.4%, wiping out approximately $28.4 billion in market capitalization. This move places Boeing in a difficult position, particularly in industrial states, such as Washington, Missouri, and South Carolina, where thousands of jobs are now at risk. Simultaneously, China has tightened export controls on 7 types of rare earth minerals, including gallium, germanium, and dysprosium. These materials are essential for the production of electric vehicles, semiconductors, and defense-related technologies. According to Bloomberg, China currently accounts for nearly 70% of the global supply of these strategic minerals. The new restrictions have pushed up the cost of electronic components, directly impacting the prices of everyday consumer goods, such as smartphones, electric vehicles, and household appliances. At the Port of Los Angeles, the number of ships waiting to unload has surged, with average wait times reaching 96 hours, the highest since 2021. Imports are delayed by 3 to 5 days, driving up logistics costs and retail prices. Consumers now face product shortages, price hikes, and delivery delays. To reduce the impact of tariffs, Amazon has canceled many orders from China and other Asian countries. As a result, products like clothing, electronics, and appliances are delayed by 10 to 21 days, with prices rising between 5 and 15%. The U.S. auto sector is under pressure. Ford has halted production of its electric F-150 Lightning, while General Motors has cut output by 60% at its Tennessee plant due to shortages of Chinese components. Car buyers now face higher prices, fewer discounts, longer wait times, and in some cases, fewer features. Prices and capital flows are undergoing significant fluctuations, reflecting macroeconomic risks arising from escalating trade tensions. In April 2025, the average price of a new car in the United States rose to $47,770, an increase of $2,600 compared to the previous month. This surge is largely due to rising production costs and ongoing shortages of essential components. It places a heavier financial burden on consumers while limiting their options when searching for vehicles within their price range. At the same time, China has reduced its holdings of U.S. Treasury securities to $759 billion, the lowest level since 2011, according to the U.S. Department of the Treasury. This move has raised concerns that continued sell-offs could push interest rates higher, affecting mortgage costs, personal investments, and household spending. Furthermore, a slowdown in capital availability may delay key defense and energy projects, contributing to ongoing supply shortages and rising prices in the U.S. electric vehicle sector. The U.S. hits China with a 245% tariff, Beijing strikes back, Trump claims prices are falling, and New York's Attorney General faces a mortgage fraud probe. Where will this trade standoff lead? Toward negotiation or escalation, just months before the election? On April 17, 2025, former President Donald Trump announced a 245% tariff on Chinese imports, pressuring Beijing to appoint an official trade representative and return to the negotiating table. The move is aimed at securing more favorable terms for U.S. trade and curbing what Trump described as unfair economic practices by China. If talks proceed successfully, stabilized prices on Chinese consumer goods, such as clothing, electronics, and household items, could relieve pressure on U.S. households. Currently, steep tariffs have raised costs across the board, directly impacting American consumers' daily expenses. Experts suggest millions of American families could benefit from more balanced trade terms, easing inflation concerns and improving domestic economic stability. Before signaling openness to talks, China launched significant retaliatory measures. Beijing canceled all pending aircraft orders with Boeing and banned the purchase of U.S. planes and aerospace components. More critically, China suspended exports of 6 key rare earth minerals, essential to U.S. defense and high-tech industries. This rare earth embargo poses a serious threat to American manufacturing supply chains, particularly in electric vehicles, smartphones, computers, and weapons systems. If prolonged, the move could drive up production costs, leading to higher retail prices and impacting both consumers and workers in affected industries. Following April 5th remarks, Trump claimed that prices on gasoline, food, and mortgage rates have declined. He also said tariff revenue is pouring in and fueling the U.S. economy. However, Treasury Department data shows daily tariff revenue averaged just $259 million in February and $263 million in March, well below Trump's claim of $2 billion a day. Meanwhile, housing supply has reached a 15-year high, with over 500,000 newly listed homes across the country. The surge in supply may help ease housing prices, providing more opportunities for working families and first-time buyers. Still, some economists warn the trend may be temporary and not reflective of long-term market shifts. According to a recent University of Massachusetts Amherst poll, just 2% of Trump voters say they would change their vote if given another chance, down from 3.5% in 2017. This signals strong loyalty among Trump's base and suggests he could maintain significant grassroots support heading into the 2024 election. Such unwavering backing could shape U.S. policy direction on trade, taxes, and immigration. If Trump returns to office, potentially leading to extended tariffs, tighter immigration controls, and a more inward-looking economic strategy, directly affecting jobs and consumer prices. New York Attorney General Letitia James, known for high-profile lawsuits against Trump, is now under federal investigation for alleged mortgage fraud. Reports claim she misrepresented her primary residence and marital status to obtain financial benefits, potentially violating federal lending laws. If the allegations are confirmed, the case could undermine public trust in the justice system and raise concerns over whether powerful figures are exploiting financial systems that everyday Americans increasingly struggle to access, especially in securing home loans amid high interest rates and strict lending standards. The U.S. disrupts supply chains and raises risk of global recession. The United States is increasing pressure on countries to choose sides between Washington and Beijing, particularly in the high-tech sector. Could the U.S. China tech confrontation pull the entire world into a new economic downturn? The United States is advancing a strategy aimed at distancing China from the global supply chain, particularly in the high-tech sector. The Washington administration has expanded export control measures, not only applying them to American companies, but also requiring foreign firms to choose between cooperating exclusively with the U.S. or with China. According to Bloomberg, the U.S. has imposed an additional 20% tariff on a wide range of Chinese products and has further extended its chip export restrictions. The restrictions on chip exports to China have also resulted in significant losses for American businesses and their global partners. According to Bloomberg, October 2024, NVIDIA is expected to lose $5.5 billion in revenue due to its inability to sell advanced AI chips to China, an amount equivalent to roughly 20% of its projected 2025 revenue. ASML, Netherlands, the world's leading manufacturer of chip printing machines, has warned that its revenue from the Chinese market could decline from nearly 50% to just 20% by 2025. Companies such as Tokyo Electron, Japan, and Samsung, South Korea, face similar risks. Disruptions in the global chip supply chain are likely to drive up the prices of consumer technology products, such as smartphones, laptops, and electric vehicles, due to increased production costs. Furthermore, if companies are forced to reduce investment and cut jobs to offset losses, the risk of rising unemployment in the tech sector will grow. The impact of the U.S. China competition, combined with rising protectionist policies, is fueling concerns about a potential global recession. According to an end-of-year 2024 report by the International Monetary Fund (IMF), the risk of a global economic downturn in 2025 stands at 30%, more than double the level recorded the previous year. In December 2024, the European Central Bank (ECB) announced it would continue to lower interest rates, following a drop in Eurozone inflation to 2.4%, the lowest level in nearly 2 years. As central banks tighten policies to manage risk, businesses may face greater difficulty accessing capital, which could hinder growth and employment. In the United States, the Federal Reserve has maintained a cautious policy stance, while consumers are increasingly tightening their spending. This reflects mounting pressure on everyday life, with persistently high prices for essentials such as food, energy, and loan interest rates for home and auto purchases. According to a survey by the Conference Board, U.S. consumer confidence dropped by 9 points in the fourth quarter of 2024, driven by concerns over prolonged inflation and rising living costs. In November 2024, former President Donald Trump announced that he would replace Federal Reserve Chairman Jerome Powell if re-elected, stating that Powell does not support his economic policies. This statement has raised concerns in financial markets about the potential loss of the Fed's independence, an essential factor in maintaining monetary stability. At present, the Fed has no stated plans to intervene should a market crisis occur, raising questions about its ability to respond effectively in times of major economic volatility. Since late 2024, foreign investors have begun withdrawing from U.S. government bonds. Meanwhile, gold prices have risen by 14% in just 3 months, signaling a growing trend toward risk aversion. For American households, this environment means higher mortgage and consumer loan interest rates, while a weakening U.S. dollar is driving up the cost of imported goods. If the Fed were to lose its independence, monetary policy could become more susceptible to political influence, directly impacting consumer spending, price stability, and employment opportunities. China unexpectedly halts U.S. beef imports, disrupting $2.5 billion in exports. What's behind the move, and who stands to lose? As of March 16, 2025, China has not renewed import permits for over 300 U.S. beef processing facilities, rendering a significant portion of American beef exports ineligible for entry into the Chinese market. This move follows the United States' decision to impose a 25% tariff on Chinese electric vehicles and related components, and is widely seen as part of Beijing's broader trade response. According to U.S. government data, beef exports to China plunged from an average of 2,000 metric tons per week to just 54 tons in the week ending March 20. China has also imposed additional tariffs of 10% to 15% on U.S. agricultural products, including beef, making American goods less competitive in the Chinese market. In 2024, the U.S. posted a record $8.63 billion in pork exports, with total volume reaching 3.03 million tons. Beef exports contributed $10.5 billion, accounting for roughly 14% of total domestic production. China has played a key role in this growth, representing 14% of U.S. beef export volume and 15% in value, along with 15% of pork volume and 13% of its value. Since March 2025, however, China has levied steep tariffs, 56% on U.S. beef and 81% on pork, further eroding the competitiveness of American meat products and triggering a sharp decline in exports to this vital market. As a result, surplus supply is building up domestically, putting downward pressure on prices. According to the U.S. Department of Agriculture, USDA, wholesale beef prices fell 1.9% in February 2025, while pork prices dropped 6.2% in January, before rebounding 7.9% the following month. While the price decline may benefit American consumers in the short term, with more affordable meat at the grocery store, long-term disruptions in export channels could reduce farm incomes, affect employment in food processing, and impact related agricultural commodities, such as corn and soybeans. In the wake of China's higher tariffs on U.S. beef and pork, Russia has seized the opportunity to strengthen its presence in the Chinese market. Sergei Dankvert, head of Russia's Federal Service for Veterinary and Phytosanitary Surveillance, Roslkoznadzor, stated that Russian meat exports are expected to reach 1 million tons in 2025, up from 860,000 tons in 2024. China, the world's largest consumer and importer of beef, brought in a record 2.87 million tons in 2024. Russia's pricing and quality advantages are positioning it as a key alternative supplier. The expansion of Russian meat exports may also help stabilize domestic Chinese meat prices, especially as beef prices fell by 22% in 2024 due to oversupply. Rising beef imports in China reflect increasing consumer demand, driven by higher incomes and a growing preference for premium meat products. To reduce dependency on a limited number of suppliers, China has broadened the list of approved beef exporters. Recent policy changes have allowed more producers from Australia and Russia to enter the market, while easing restrictions on German beef. Other key suppliers include Brazil, Argentina, Uruguay, Belarus, and Chile. For Chinese consumers, this diversification helps ensure supply stability and price consistency, meeting the country's growing demand for beef. For the U.S., however, China's strategic pivot in sourcing could lead to prolonged oversupply in the domestic beef market, with potential implications for pricing and agricultural sector stability. U.S. imposes a 145% tariff on Chinese goods, shaking world's markets and revealing risky economic ambitions. The 145% tariff recently imposed by the United States on Chinese goods hasn't just rocked global markets, it's sparked big questions about Washington's new economic strategy. Is this truly just a tariff decision, or the opening move in a much larger economic showdown? It confirms total tariff rate on Chinese goods reaches 145%. The U.S. government has officially confirmed that the total tariff rate on certain imports from China has reached 145%, including a previously established 20% and a newly added 125%. According to a statement from the White House, this move is part of ongoing efforts to recalibrate the trade balance and address concerns surrounding industrial policy and economic security. Following the announcement, U.S. financial markets reacted noticeably. The Dow Jones Industrial Average fell by 3.4%. The S&P 500 declined by 4.2%, and the Nasdaq dropped 5%. These shifts reflect growing investor caution amid expectations of higher import costs, which could weigh on corporate earnings and dampen consumer outlook. Following a strong rally in early April, the U.S. stock market has experienced a downturn after news emerged that the U.S. government would impose a 145% import tariff on Chinese goods, specifically since April 2nd, when former President Donald Trump announced the tariff hike plan. The S&P 500 index has dropped approximately 6%, despite a session where it had gained over 9% shortly thereafter. In the trading session following the announcement of an additional 125% tariff, bringing the total tariff level to 145%, the Dow Jones Industrial Average fell by 1,700 points, around 4.14%. The Nasdaq declined by 5.75%, and the S&P 500 lost nearly 5%. Many experts believe that the high tariff levels have heightened concerns over import costs, directly impacting corporate profitability. Investor sentiment has also been affected by the lack of clarity surrounding trade policy direction, prompting more cautious behavior. The movement of capital away from equities towards safe haven assets, such as gold and bonds, highlights the increasingly defensive posture of the market. Bond market, according to former U.S. Treasury Secretary Janet Yellen, former President Donald Trump's decision to delay the imposition of tariffs on Chinese goods for 90 days reflects pressure from financial markets, particularly the U.S. government bond market. Following the announcement of the 145% tariff rate, the yield on 10-year U.S. Treasury bonds surpassed 4.4%. Rising sharply from around 4.1% in early March, this surge in yields was largely driven by a wave of investor sell-offs, which caused a significant drop in bond prices, a signal of growing uncertainty surrounding traditional safe haven assets. This development is regarded as a warning sign for the U.S. administration, as a continued decline in bond prices could raise government borrowing costs and potentially impact the standing of the U.S. dollar in international markets. While the White House has stated that the temporary delay aligns with its original plan, many financial experts believe the market's strong reaction compelled the administration to postpone full implementation of the new tariff package in the short term in order to ease systemic pressure. Small and medium-sized enterprises. According to expert Zongyuan Zoe Liu of the Council on Foreign Relations, CFR, the United States' decision to impose a total tariff of 145% on Chinese goods may have far-reaching effects on small and medium-sized enterprises, a sector that accounts for approximately 80% of China's export value and between 70 to 80% of employment in its manufacturing industry. These SMEs primarily operate in low-margin sectors, such as electronics, textiles, auto parts, and household appliances, and rely heavily on access to the U.S. market. The high tariff rate undermines the price competitiveness of Chinese goods, leading to canceled orders and reduced export volumes. According to data from China's Customs Authority, exports to the U.S. in the first quarter of 2025 declined by 8.6% compared to the same period last year, though marking the steepest drop since the COVID-19 pandemic. According to Zongyuan Zoe Liu of the Council on Foreign Relations, CFR, the U.S. policy proposal known as the Mar-a-Lago Accord, named after former President Donald Trump's resort, could have concerning economic consequences if implemented. Under this framework, the United States seeks to simultaneously achieve three major objectives. 1. Systematically devalue the U.S. dollar in order to boost exports and enhance the competitiveness of American goods in global markets. 2. Maintain the U.S. dollar's global dominance as the primary reserve currency in the international financial system. 3. Transition the U.S. from a trade deficit to a trade surplus economy, while also calling on allies to contribute more to regional security costs. However, LIU notes that the aim of devaluing the dollar to support exports, while preserving a strong dollar to safeguard its global position, presents a fundamental policy contradiction. Historical experience from the 1985 Plaza Accord shows that currency realignment can create short-term advantages, but often leads to financial instability. Moreover, the U.S. has consistently run trade deficits since the 1970s. In 2024 alone, the trade deficit stood at approximately $773 billion, according to the U.S. Bureau of Economic Analysis, BEA, reflecting the persistent nature of the imbalance. Despite previous policy efforts, if the Mar-a-Lago Accord is implemented without coordination from major economies such as China, Japan, or the European Union, all of which hold significant amounts of U.S. Treasury bonds, confidence in the U.S. dollar could be weakened. potentially leading to instability across the global financial system.